So there's a lot of talk out there right now about interest rates, and there's a lot of doom and gloom, but we wanted to let you know that if you're an investor or you're looking for a second home, there are some really great options out there. And this is Kate Logue with Citizens Bank. She's going to tell us a little bit about some good news and some good options that are out there for our buyers, investors, and second home buyers. Kate, thank you so much for joining us.
Again, thank you so much for including me.
Of course.
This is absolutely terrifying, but we're just going to give it a go.
You got used to it. It's fine.
We're going to give it a go.
Well, let's just start with the definition. What's the difference between a second home buyer and an investment buyer if it's still not their primary residence?
Okay, so it's a great question, and I think we're going to just put it in lender's terms.
Yes.
All right. If you're buying a property and you have no intention to reside in said property,
okay,
and you would like to use any rental income derived from said property,
okay,
the lender will consider that non-owner occupied or investment.
So that's when you're using the income to qualify for the mortgage.
You're helping to offset your expenses by showing either a lease or what we call a rent roll analysis, where they will evaluate the collateral and compare other rentals. So here at the beach, I believe that you could call it a hybrid,
right?
Actually,
Okay.
Because so many people purchase their homes with the full intent of using it themselves, and more so than they would put a tenant in the property.
Right.
But let's be honest, you can't overlook the marketability factor.
Yeah.
So again, if we're just using it in lender's terms, if you're going to use the property less than you intend for your personal use, then you would put a tenant in. That's going to be investment.
Gotcha.
If you're going to buy a property and you fully intend to max use your property, and you're not using any rental income that would be derived from those weeks that you decide you're not going to occupy the property and can take advantage of the marketability, then that can be considered a vacation home. With the caveat that any income derived, you cannot use for qualifying purposes.
Gotcha. So if you decide down the road you want to rent it, that's fine. You just can't use the income to qualify.
Correct.
Okay.
Every time you finance a property, you have to keep in mind that there's a word intent. So today, it is my intention to utilize this as an investment.
Right.
As I build my wealth, I may have the privilege and the prerogative to say that this is no longer an investment property.
No more people in my house.
Correct.
Right. But all that matters for our scenario is the intent at purchase.
Yes.
So tell us a little bit about the programs that you have and the difference between, now that we know the difference between a second home buyer and an investor, what good news do you have for them?
Well, I think that the good news is there are still a lot of dollars out there that lenders want to help people purchase homes. There's just no question about that. If we're discerning between a vacation home and a true investment, what you have to understand is with each property type, there's what we call a layer of risk. So an investment property is going to come with a greater risk than that of a vacation home in terms of foreclosures.
So that's why it's a larger down payment.
Correct.
Okay.
Excellent evaluation of what we're talking about. Yes, with risk comes a need for a greater position.
Leverage. Right.
Yes. Yes. The bank might say, well, we'll take this transaction, but we'd like to see you put a little bit more money down.
Right.
So an investment property, you might want to see 25 to 30% down and recognize that I'm using that as one unit.
Right.
There's multi-units. You're probably going to have a little bit more contribution towards your down payment.
So it goes up as the number of units go up.
Yes. In the world of financing, we in residential will go 1 through 4 units.
Okay.
So keep in mind, for this conversation, we're just talking about a single family or a 1 unit. For a vacation home, I would say set the expectations for 20% down. It eliminates the need for mortgage insurance.
Right.
However, in the world of conventional financing, provided mortgage insurance is approved, you can acquire a property as a second home with 10% down.
Okay.
So vacation homes, 20% down.
Right.
Okay. There are maybe programs where they can utilize other products in tandem to put less than that down.
Okay. And still avoid the mortgage insurance.
Still avoid the mortgage insurance being the tool.
So what do you mean by in tandem, just so that we're all clear?
So tandem is just what I said. Think of a tandem bicycle. Right. It's two.
Yeah.
Then a tandem loan means that there is a first lien and a second lien in simultaneous position. Lenders, particularly Citizens Bank, would like to lend for people who want to buy vacation homes and investment properties. You need to understand that the criteria for qualifying is going to be a little bit more stringent than that of a primary home.
Of course. So
you're going to need a little better credit scores than the norm. I would say you should assume 720 or better. Okay. Any credit score above that typically comes with a premium to the customer that is, you're at a better rate. You're going to have the ability to select fixed rates or ARM products.
I'm hearing a lot of people are doing ARMs these days.
Well, if you use what I say is you marry the house, you date the rate.
Yeah.
Again, corny. But
you do think that in a couple
it does
years.
make sense.
Yeah.
Well, we talked about in a former conversation where the average second home buyer is 4 to 6 years. Right. So in our product, if you could get in 7 or 10 years, and the interest rate is full percent below where a conventional fixed rate would be.
And you also have jumbo ARMs as well, correct?
Yes, and that's a great question. So there's several types of lending. There is government lending, which is specific to a location. Then there's conventional lending, which is Fannie Mae, Freddie Mac. They set the terms for what their max financing will be in a certain area. Right now,
there's
2022.
Okay.
The Fannie Mae, Freddie Mac limit is $647,250. Right. Anything above $647,250 falls into what we call jumbo lending. Right. Jumbo lending means that it is a loan that is going to be placed where Fannie Mae and Freddie Mac are not guaranteeing the loan. Right. Or not. Right. You can get jumbo loan for 20% down versus conforming loan, which requires 20% down, but you can't meet that number unless you put more money down. Then you need to be cognizant that there are opportunities out there.
And I know you mentioned some of the buyers that you're dealing with, they're doing a lot of interest only. How is that beneficial, and what are the parameters generally?
An interest only loan is really for the very, very savvy borrower. Right. You're never going to put that in the hands of somebody who is new to the world of financing. To that end, for those buyers that are looking for cash flow management, interest only is a great tool.
I agree.
What it means is the buyer has the ability to make interest only payments for a period of 120 months. So certainly on those products, you're going to require a larger down payment. Right. Certainly on those products, you're going to have a much more stringent qualifier. Right. Certainly on those products, you're going to require what we call money after closing. Right. Or in my world, post-loan liquidity. Yeah. It is an excellent product that allows people to utilize cash flow management, making interest-only payments, making contributions towards principal. Right. As they make a contribution towards principal, they actually are allowing themselves to recast. Right. Recast means that your principal balance has gone down,
Mhm.
and therefore your monthly payment will go down.
Right.
On a standard amortized loan, that will never happen.
Of course. No.
Now, there are opportunities through Citizens Bank that you can request a recast.
Okay.
But on an interest-only loan, you don't have to do that, and there's no fees associated
That's
with
so
it.
interesting. I know a lot of my wealth management clients have been looking at this option because it just makes the most sense to them.
Well, it's funny you say that.
Mm-hmm.
The wealth planners
Mm-hmm.
love this
They're
product.
waiting for this. Yeah.
Love this product.
This market, the products.
Because it does allow their people to get in
right.
with a fairly low down payment. 20% is typical
Mm-hmm.
on these products. And you will have the ability to have your customer take those
Right.
dollars that they're not allocating towards
Mhm.
their
Right.
equity position
Mm-hmm.
and utilize them for other opportunities.
Yeah.
Well, the interest-only product
Mm-hmm.
is for the savvy
Right.
borrowers.
Not for
It
everybody.
was a product that was introduced in the commercial world,
Mm-hmm.
and only certain lending institutions could offer it.
So what happens? Is it like a balloon at the end, or it just adjusts?
So you're asking a great question.
Mm-hmm.
So if we use an example of a 10-year arm
Mm-hmm.
with interest only.
Okay.
The interest rate is
Okay.
fixed for
Right.
the 10 years. That's
Mhm.
120 months. You have the ability during that 120 month to contribute only to simple interest.
Only.
That's correct.
Wow.
But what you need to recognize is if you're never contributing to your
It
principal,
doesn't change.
then your balance starts
Yeah.
and ends at the same number.
Mhm.
We actually encourage principal reduction.
Right.
I would think
Yeah.
That would be how you manage
Right.
the loan.
Okay. Good. That's better.
However, there's no requirement during that 120 months.
Okay. Have you paid all the interest by the end of that time?
That's a great question. I would say we would look at an amortized loan versus an interest loan, comparing a table.
Right, because it's amortized over 30 years still. not
Correct.
10.
And when
So-
you're thinking about this, you would say that the majority of the loans
Mhm.
in the first several years are going
Mostly interest.
interest. Correct.
Right. Yeah. it's
So
very depressing.
you asked the question, which is what happens when?
Right.
So rates fixed for 10 years,
Mhm.
interest only for 10 years.
Mhm.
Again, excellent tool.
Right.
Got to manage it,
If you're ready.
because
Right.
what happens
Mhm.
in the 121st month
Mhm.
is, one, your loan adjusts, and it can adjust positive or negative depending upon what your
Whatever.
start rate is.
Mhm.
Typical arms adjust to what we call an index
Mhm.
and a margin.
Right.
Index is whatever the cost of funds is. That could be SOFR, that could be cost of funds, that could be treasury.
Okay.
Margin is a number that never changes. That can be anywhere from 2 to 3.
Mhm.
Okay? You take those two numbers and add them together.
Yes.
When the loan adjusts, well, if the index is low, as it was over the last 4 years,
It's great. Then.
it's wonderful. If the index is high, then, which is what we're seeing right now in the 2s and 3s, then when those numbers adjust, it's going to adjust to the higher number.
Dramatically.
So the consumer is in a situation where they need to be cognizant that the rate can go up, or it can go down, but the rate can go up.
Mhm.
Mhm.
And they need to be aware that the principal balance, if they've chosen to retain said
Hasn't
principal
moved in 10
balance at the
years.
same, hasn't moved. Again, that's not the end of the world if the borrower is in a position where they sell the property or they know they're going to restructure the financing.
And it's still worth what it was worth.
Because
10
remember,
years
again,
ago. Right.
Added to the 121st month rate adjustment
Mhm.
is the loan now becomes an amortized
Right.
loan.
Mhm.
So now you have a 20-year term with the principal balance that you started with at a higher interest rate. That
Okay.
sounds scary, but
Okay.
again,
That answers my
for
other question.
the appropriate buyer,
Right.
for the appropriate term, for the appropriate execution,
Mhm.
it's an excellent tool.
Right.
Right.
Now, if they're smart
Mhm.
and they have the ability to manage their debt through an interest payment only,
Okay.
and they allocate X number of dollars towards principal on an annual basis, they will achieve that goal a lot faster
Of course. Yeah.
than someone who was taking a 30-year amortized loan. So you will never have a balance higher than where you started.
Okay.
You will potentially have a payment higher than where you started,
Of course, right.
and an interest rate from where you started.
Mm-hmm.
But you will 100% never have a negative amortization loan. That is what happened in the 2008 crash. Those products were sold irresponsibly.
Yes.
As I said, you really have to put this in the hands of the savvy,
Of course.
buyer.
Right.
Buyer, borrower, beware. There has to be tools in place that allow the buyers to take advantage of certain products and programs as long as they qualify and understand the ramifications. That's what I say about contracts. They're not suggestions.
Right.
You're signing something and you're making a promise. When you sign a note, that's your promise to pay.
Yeah, they used to call
When
it that.
Exactly. When you sign a mortgage, that is your collateral. That is what you are putting up
For your promissory note.
for the fact that you are borrowing this money, which essentially says, hey, if I don't make good on this note, you have every option to take said collateral.
That's the point. Well, that's why we love using you, and we love collaborating with you with our clients, because you do teach the client what is going on, what their options are, and you get very creative, and we love that about you. So thank you so much for being here.
Creativity and a trusted advisor
Yes.
should go hand in hand.
I agree. But also, like, you're like a good teacher, like, you know, explaining to the clients exactly what their options are and what the situation is. We just really love that, and we trust you with
Well,
them.
thank you. I'm comfortable from the first time buyer all the way up to the most high net wealth individual.
That's amazing. Yeah.